This recording is for informational purposes only. It does not constitute legal, financial, or investment advice.
The views expressed are those of the hosts and guests and do not represent any organization, including Bank of North Dakota. Please seek professional guidance before making financial decisions.
Welcome back to 701 Chain, Fintech for Financial Institutions. I'm Michael Lehn, here with my co-host, Devon Smith. Today, we're recapping the biggest fintech and digital asset stories from the month of May. A month packed with major moves across AI, payments, and financial infrastructure. Let's get into it. First up is Circle. As we recall, Circle is one of the larger stablecoin issuers in the United States, issuing USDC. Financial IT Weekly highlighted their launch of new AI-focused infrastructure built for what they called the agentic economy. Circle is pushing to make digital dollars work smoothly with AI systems. Instead of humans running every step, their tools let AI agents move money safely and in real time. The idea is simple. Turn stablecoins into full programmable layers. That means faster payments, quicker settlements, and automated tasks that don't need human steps in the middle. It's a clear signal that digital dollars and AI systems are starting to work together, and it may shape how automated commerce runs going forward.
Awesome. Yeah, it's not surprising to see Circle kind of being tech forward, leaning into the AI space in general.
Yeah, I think it will help bring more demand in their eyes to USDC.
Yeah, hopefully, we'll see what happens with them. So lawmakers advanced the revised Digital Asset Market Clarity Act, bringing long-awaited structure to the crypto regulation. So this splits up who's regulating what on a practical level between the CFTC and the SEC. So the CFTC is going to have more of those digital commodities like your Bitcoins, like your XRPs, and the SEC is going to stick with just digital securities. Stablecoin rules, those were heavily debated both publicly and privately. So the compromise is that passive yield on stablecoins is going to be a no-go, but you will have activity-based rewards, and it's going to be curious to see how that works in practicality for the consumer. Tokenized securities get their own regulatory treatment, so that is going to fall under the CFTC as well. The vote was 15-9. So if those in committee, if those margins stay the same, it will pass in the Senate with about a 62 vote. They're targeting that bill being signed on July 4th, so it'll be kind of a ceremonial signature on the nation's birthday. But the real banker takeaway here is that more regulatory clarity may increase institutional engagement with digital assets as a whole.
Going back to what you just talked about with the rewards coming into stablecoins when it comes to activity or yield bearing, is that kind of similar to credit cards?
Kind of, yeah. I mean, I think that's where they kind of struck that balance on, but there's just so many different ways to transact and have activity with stablecoins, whether it's staking and all these other different things that don't necessarily exist in the current market. So like I said, it's going to be really fascinating to see how it actually plays out.
Next up is Augustus National Bank. The OCC gave them conditional approval in May to open a new national bank based in Dallas. Augustus is a young company with a young CEO, just 25 years old. They were once called Ivy, but rebranded this year as they shifted towards building modern banking tech. Their focus is simple. They want to be an always-on, AI-driven clearing bank. That means faster payments, real-time settlement, and support for things like stablecoins. Always running 24/7 without the old manual steps traditional banks rely on. With this charter, they can now expand into US dollar clearing on top of the euro clearing work they already do overseas. It's a fresh model and one worth keeping an eye on. Devon, we continue to see these patterns, one with programmable money and one with OCC charter approvals.
Yep. Yeah, and I think like we've talked ad nauseum about the OCC charters, but to me, this is a more practical, like, what does that mean downstream? So you have the approval, you have the charter. What are you actually going to do with it? And I think Augustus National doing this is really showing what the broader macro strategy is going to be for these OCC seeking fintechs. So next up, we have the CFPB. So the CFPB issued their final revision to Section 1071, which really narrowed the requirements for compliance, specifically with small business lending. So it used to apply to about 2,500 lenders when initially written in 2023, and now that's going to be scoped all the way down to 280. So a massive strike field. The data sets shrink from 81 down to 13 different collection points, and a lot of the demographic type data sets that used to exist under the previous administration that don't necessarily align with the current administration have been completely stricken. So only lenders with 1,000 or more small business loans annually will be subject to the rule. And the small business has been refined. Instead of being under 5 million, now it's under 1 million to be defined as a small business under the CFPB.
Interesting.
So it's estimated that this is going to save banks and credit unions about $166 million in total for annual compliance that they would have otherwise had to do. The real banker takeaway here is that most community banks and credit unions are going to fall outside of this new scope. But big lenders are still going to be subject to the rule, so they should be paying attention and building the infrastructure in case that does roll downhill with that political rubber band.
I was just going to bring that up. Are you worried about the political rubber band?
I would be, but I would say that this rule was initiated in 2023, so we've already seen it swing back. So whenever they want to have new revisions, I should have said too that this will actually go into effect in 2028.
Oh, okay. All right.
We're going to be ripe in the beginning of election season there, so we'll see what happens.
Lastly, we have Stripe. At their annual conference, they announced new tools built for the agentic era, a time when AI agents, again, not people, will handle most online transactions. Think about eBay, Amazon, etc. Stripe is building payment rails that AI systems can use directly. Their tools are designed to let software handle purchases, approvals, and simple financial tasks on its own. The idea is straightforward. If AI is going to shop, trade, and move money, it needs a clean way to plug into payments. Stripe is betting big that automated commerce is coming fast, and they want to power the rails that make it work. This is another common theme that we've been hearing throughout the conferences that we've been attending. Right. And that within, you hear a very broad range of estimates within, the next 2 years, 5 years, 10 years, that there's going to be more AI agents utilizing these payment rails than there are humans utilizing these payment rails. What are your thoughts on that?
Yeah, I think it's one of those funny things where you're going to have an AI agent on the consumer level, and then you're going to have an AI agent on the producer level, and there's no human actually making this transaction. It's just the AI agents interacting with each other. And now that you have Stripe that's building the financial backbone of it, it just makes that all the more true. Now, what I think is really interesting is like downstream effects of agentic AI are like advertising dollars. Where are those going to shift to? How are you going to effectively communicate to your consumer, whether you have a banking product or not, what products you have if the agent's the one doing all the transactions on your behalf? Well, thanks for listening to our May recap. Be sure to join 701 Chain and follow us next month as we continue exploring the future of fintech and financial institutions.